Earning just one extra dollar can send a family's health insurance bill up by more than $10,000 a year, and almost nobody sees it coming. Cross the Affordable Care Act's 400% poverty line by a single dollar, and your entire subsidy can vanish overnight, with no gradual phase-out to soften the blow. I read the fine print so you don't have to. Millions of Americans on marketplace plans sit near this invisible edge, and the reason is a hard cutoff most people never hear about. Today, I'll show you 3 moves. Calculate your safe income zone, use pre-tax contributions to duck under it, and avoid taxable withdrawals that push you over. Here's the number at the heart of this: 400% of the federal poverty level. According to CMS and IRS 2025 rules, that's about $124,800 for a family of 4, and $1 above it can drop your premium tax credit straight to zero. But here's the part nobody tells you. It doesn't fade out, it falls off a cliff. 3 moves keep you off that cliff. Find your safe income zone, use pre-tax retirement contributions, and steer clear of taxable early withdrawals, each free and under 20 minutes. So how does this actually work? Under the ACA, households between 100 and 400% of the poverty level get a premium tax credit that caps what they pay toward premiums, according to CMS. But at 400% and above, that credit historically drops all the way to zero. There's no middle ground, just a wall. Look at what that wall costs. At 399% of the poverty line, a family might owe only 8 or 9% of income toward premiums, roughly $9,600 to $10,800 on $120,000 income per CMS and IRS Form 8962. Cross to 401%, and they owe the full $15,000 to $18,000, losing $5,000 to $7,000 in credits instantly. Now, here's the second layer that catches people off guard. The ACA uses modified adjusted gross income, your MAGUE, which includes wages, interest, capital gains, and taxable 401k withdrawals, according to IRS rules. That means a bonus, some overtime, or an early retirement withdrawal can quietly push you over the line even when your take-home cash barely moved. Say you pull $15,000 from a traditional 401k for home repairs. That whole amount lands in your MAGI, and if it crosses 400% FPL, you repay roughly $5,000 in advanced credits, per CMS and IRS guidance. Add a 10% early withdrawal penalty of about $1,500 and around 22% income tax. And one withdrawal becomes a $9,800 hit. Here's the myth that costs people the most. If I only go a few dollars over the limit, I'll just lose a little of my subsidy. The fact, per IRS Form 8962, is brutal. $1 over 400% FPL zeros the entire credit, and every advance payment must be repaid. Put the 2 costs side by side. Losing the credit at the cliff can add up to $10,000 a year in premiums for a family of 4, per CMS and HHS 2025 figures. Repeat that across 10 years of accidental crossings, and you're looking at $50,000 in lost subsidies alone, before you count lost retirement growth. Meet Lisa. She's 44, a project manager earning $80,000 combining her salary and freelance work, married with 2 kids. She has a $110,000 traditional 401k, 21 years to retirement, and an ACA Silver plan with a healthy subsidy. Here's what Lisa found when she ran her own numbers. First discovery: the $1 trap is real. Reading her marketplace notices and the IRS Form 8962 instructions, Lisa learned that if her household income ever nudged just above 400% FPL, around $125,000, her entire premium tax credit disappears. That's a $5,000 a year subsidy gone, taking her health bill from about $10,000 to $15,000 per CMS 2025 rules. Second discovery: a different layer entirely. Lisa considered pulling $15,000 from her 401k for repairs. But if her spouse also got a $20,000 bonus, their combined income would sit right at the cliff. Cross it, and she'd repay the whole $5,000 subsidy. owe a 10% penalty of $1,500 plus income tax, roughly $9,800 gone per IRS and CMS guidance. The third discovery is the most surprising. She can actually buy the subsidy back. Using her employer's 401k calculator, Lisa saw that a $5,000 pre-tax contribution lowers her MAGI by the same $5,000, dropping her back under 400% FPL and restoring her $5,000 credit. And that contribution costs her only about $3,900 after a 22% tax saving per Fidelity and IRS, a net gain of $1,100. Add it all up over her 21-year career, and the picture is staggering. Between lost premiums, penalties, and taxes, and the retirement growth she never earned on money pulled out early, mismanaging this cliff could cost Lisa roughly $232,000, an author's estimate assuming a modest 6% return. So could this be you? You buy your health plan on the ACA marketplace and get a credit. You don't actually know your household's exact FPL percentage. And you have bonuses, side income, or a 401k withdrawal on the horizon. If any of those ring true, you need to run your numbers before December. Here's the good news. This is entirely avoidable once you know the line. These 3 moves take under 20 minutes each. They're free, and they can preserve thousands of dollars in subsidies every single year. Do them, and you turn an invisible cliff into a boundary you control. Move 1. Calculate your ACA income safe zone. Log into healthcare.gov and review your estimated household income and FPL percentage. Then use the premium tax credit estimator to test scenarios, a bonus, some side income, a small withdrawal, and see exactly where your income hits 400% for your household size. This is general information, not personal advice. In practice, open your marketplace account and go to the Income and Household section. Run a few scenarios to find where you cross 400% FPL, then write down your maximum safe MAGI. What good looks like? Your projected income sits at 399% or lower. Move 2. Use pre-tax retirement contributions to stay below the cliff. Estimate your full-year income from salary, bonuses, and side jobs. Compare it to the 400% threshold, and if you're slightly over, raise your pre-tax 401k contribution by $2,000 to $5,000. Every dollar contributed lowers your MAGI dollar for dollar per Fidelity. Concretely, estimate your year-end income including bonuses. Increase your pre-tax deferral in the employer portal to drop MAGI under the cliff. Then recheck with an online tax estimator. What good looks like? Your post-contribution MAGI is below 400% FPL and your credit is preserved. Before I get to the last move, which is the most counterintuitive part of all this, remember the best material is right here at the end. Move 3. Avoid taxable early 401k withdrawals. Before you cash out, check whether your plan offers a loan or whether you have an HSA. Because a traditional withdrawal both triggers a 10% penalty under 59.5 and can push your MAGI over the cliff per IRS rules. So check for a plan loan or HSA first. Compare the 10% penalty and tax against alternatives. And if you must withdraw, size it to keep MAGI under 400% FPL. Good looks like rare, small, well-planned withdrawals that never cross the line. If breakdowns like this are useful, subscribe. The next one's already coming. Why does this matter right now? In 2014, the ACA marketplace launched with credits capped at 400% FPL, the original cliff. In 2021, the American Rescue Plan temporarily removed that hard cutoff. And in 2025, as those enhancements phase out, Sharp Subsidy drops past 400% return, meaning the cliff is officially back and income planning matters again. Once you've acted, verify it's stuck. You should see your projected FPL percentage sitting under 400 in your marketplace account. Confirm your updated 401k deferral shows in your next paycheck. And if your MAGI stayed under the line, your Form 8962 credit should hold when you file. Everything here comes from CMS and healthcare.gov, the HHS poverty guidelines, Fidelity's 401k tax explainers, and the IRS rules on early withdrawals. All the links are below, so you can check the exact figures for your own plan year. You now know how the 400% cliff works, how a single dollar can erase your subsidy, and 3 moves to stay under it. Next, I'm covering the HSA loophole that quietly lowers your ACA income and shields your credit. That HSA trick can save the same families thousands more, and it's easy to miss if you don't know it exists. If you want to catch that breakdown, subscribe now so you don't miss it.